Hi, my name is Jordan Wilson. We just finished up a few episodes looking at mutual funds, and we'll turn to exchange traded funds in a little bit. But let's take a quick segue into the passive versus active management debate. Because when we get to ETFs, we'll see that they tend to be passive investing tools, whereas we saw with the mutual funds, there's a lot of active managed mutual funds. Our objectives today, just to lay out what the differences are between passive and active investing. The first thing to note with passive investing is that the objective is to match the market return. Investors do not believe that they can beat the market, so they don't even try. If we can't beat it, we'll join it. They believe that markets, whether they be stocks or bonds or other assets, are highly efficient. And efficiency is a relative term that reflects how much public information is out there and how much information is already built into a share price. And that can be the current price, but it's also the forward price as well. The expectations are built in. So it's impossible or very, very difficult to find the buried treasure, because a passive investor believes that there really isn't any out there. And that on a consistent basis and over long time periods, it's very difficult to impossible to pick winners and losers. And I emphasize consistency and longer time period, because in the short term and on an inconsistent basis, you may be able to pick winners, but that may be more, to a passive investor, that may be more luck-based. And it's very difficult, again, to impossible to do that consistently over long time periods. So if you can't beat the market, you just want to invest to replicate the market. And the key here in replicating is to, as closely as possible, match that market return. Now, some funds may fully replicate. If I have the S&P 500 or the NASDAQ 100 or the TSX 300, I buy all the shares in that index. S&P, I'd buy 500 shares in the weightings that the index carries, because they all tend to be weighted average indices. Now that's can be a little bit pricey if I have to buy 500 stocks and monitor them in my portfolio. Other people, to try to save some money, will do partial replications. And that's where you use statistical models to determine a sample size that will provide the exact same return, mirroring the movements of the market as a whole. Maybe that's 100 out of the 500 stocks in the S&P 500. By only having to buy, say, 100 instead of 500, that's going to save a little bit of cost. And other people will create synthetic replications where they use derivatives, futures, for example, in order to replicate the market. And in that case, they're not actually buying any shares. So that's how people replicate. And depending on how they do it, both on a cost side and a success side in matching the market returns, the differential between what they get and what the market returns would be the tracking error in this case. And you're trying to minimize that tracking error and replicate the return of the market as closely as possible. Now, what you see as well with passive investing is there's minimal trading. Once I've bought those 500 shares of the S&P 500 or the 300 on the TSX composite, then the only trading I'm doing is when I have to adjust holdings if the index changes, and the indices do change periodically. And I'm not worrying about things like over or under weighting. I just put, here's the index, here's the weighting of a specific asset, I buy it. An example might be on the S&P is that in March of 2018, Nektar Therapeutics was added to the S&P 500. As the index only contains roughly 500 companies, a company had to be dropped. In this case, it was Chesapeake Energy. So if I'm holding an index fund that passively replicates the S&P 500, I would also have to sell Nektar, buy Nektar and sell Chesapeake. So that's really the only trading that you do. The other thing for a passive investor, as opposed to a passive fund, is they may need to trade based on their asset allocation. So if I'm a passive investor and my target asset allocation is 50% in a global equity index fund and 50% in a global bond fund. Very simple. But I find over time that the equities do quite well. And after 2 years, my portfolio ratio has become 70% equities, 30% bonds. Now, if my target asset allocation is still 50-50, I'm going to have to rebalance, possibly by selling a portion of the equity fund and using the proceeds to repurchase additional units of the bond fund. So from an investor level, you may have to periodically rebalance your asset allocation, even if you're investing in index funds. And the final issue for passive investors is cost minimization. So we're not trying to outperform the market, we're just trying to match it. And that means that cost control is paramount. Every dollar that you spend on commissions, loads, management fees, administrative fees, marketing fees, is going to erode your net returns in your fund against the benchmark. And because you're only trying to match the benchmark, you can't afford to have significant costs. So you can't control the market return, but you can control your costs. And that's the fixation for passive investors, is low cost investing. And the tracking error I discussed above, that's also an implicit cost. The farther your actual return from the market erodes your net returns. But I will point out that with tracking error, it can also go both ways. If my tracking error happens to be -1% to the benchmark, that would be a cost. But my inefficient replication of the market may also, at times, create overperformance just because of the way I've set up my replication. If we turn to active investors, they're almost the complete opposite of passive. They want to achieve alpha, and I've mentioned alpha a few times in previous sessions. They want to outperform their market benchmark index. They believe that markets are not totally or even highly efficient, so that there are opportunities through various tactics and strategies to find those buried treasures. They exist for an active investor. And he or she, by finding those buried treasures, can outperform their benchmark. And they do this through using different strategies, different tactics. Also through fundamental or technical analysis. Fundamental is more quantitative and qualitative analysis, where I look at things like earnings per share ratios, look at the prospects for the company, look at its management. A lot of the systematic and non-systematic risk factors we looked at previously. Technical analysis tends to be more, let's punch these numbers into a formula and that will give me a buy or sell signal based on the factors that I implement. It's less about analysis of the investment itself, more about its trading patterns and its movements versus the market. So if it breaks out of a 60-day price range going up, maybe that's a signal to buy. If it breaks out of a 180-day price range going down, maybe that's a signal to sell. So less about the company or asset specific issues, more about the trends and how it relates to the bigger markets. We see lots of trading with active investing. And I use that as a relative term, lots of trading versus passive investing. But maybe not always extensively, just on an absolute basis. Yes, you have some funds or some investors that trade heavily. And by heavily, I wouldn't call that day trading or anything, but just, every week or so they're making a trade. Others may just hold on. You may create a good portfolio. Warren Buffett, for example. I find a stock that I like and I buy it and I hold it. The active part is I sought out that specific investment, whether that be Coca-Cola, See's Candies, Burlington Railroad, I think he also owns. So he looks for attractive opportunities, buys them for the longer term. He's not in there every week. Oh, today I own Coke, tomorrow let's flip that for Pepsi, and then back to Coke 2 weeks later. He's a longer term investor, but he's active. And that's what I'm just talking about with the security analysis. You're analyzing companies. You're deciding which on a relative basis are better investments. Same is true with bonds or other assets. You look at the investable market and you find the superior performers and you buy them. And if they continue to outperform, you keep them. And when they don't, you move on to another investment. You also see market timing, which is trading. So if I own the S&P 500 and I'm a passive investor, I just hold the S&P 500. Unless there's additions or deletions from the index, I don't make any trades. But if I'm market timing, let's say I'm cruising along and the US economy is heading into an economic slowdown. So the S&P 500 is made up of growth, value, cyclical, defensive, all sorts of different types of stocks. If I see it heading into an economic slowdown, it may be prudent for me to move out of the cyclical stocks and replace them with more recession-resistant investments, like defensive stocks, maybe some value stocks. The passive investor doesn't do this. He or she just rides the wave of the entire S&P 500. Another example would be your information tells you the precious metals market is expected to significantly outperform the overall market, while healthcare is expected to do relatively poorly over the coming year. If I own the S&P 500, I'm going to continue holding companies such as Abbott Laboratories, Aetna Insurance, Cerner, Medtronic, Zimmer. Whereas the active investor might say, okay, I'm going to take these sort of healthcare related companies, sell them for the time being because we're expecting them to fall in value, and I'm going to replace them with companies like Freeport, Newmont, other mining or precious metals companies. So again, there's two examples of market timing. You could also engage in more complex tactics. Leverage, so you're borrowing to invest and get a bigger bang for your buck. Derivatives, or some investors may short sell. We saw that with the hedge funds in recent times with GameStop. They were shorting, trying to drive GameStop into bankruptcy, and that was their strategy. Again, that has nothing to do with an index or passive investing. That's an extreme example of active. And the final point with active investing is it's all about net returns, not cost control. We saw the passive investors, cost control is key. Active investors realize they will incur higher costs. There's more work being an active investor, especially if you're investing maybe into a niche market. And because of that, there's going to be more cost. Also more trading costs. But they believe that on a net basis, they can still beat the market benchmark. And that is really the $64,000 question. And an example of this would be, let's say our benchmark for both active and passive is the S&P 500. Last year, we'll say it returned 10% for the year. Now, a passive strategy is going to replicate the S&P 500. And because all you're doing is replicating, it'll be very low cost. We'll say 10 basis points. 0.1%. If there's minimal to no tracking error, then the net return under the passive strategy should be 9.9%. Quite close because it's very low cost. An active fund that uses the S&P 500 as a benchmark, it may have a total expense ratio of 1.5%. And that's not unrealistic at all. In fact, that's probably on the low end. So significantly higher than the passive fund. It therefore has to actually earn 11.5% just to break even on a gross basis with the index. So that's significantly more, especially when you look at it on a percentage basis. 1.5 may not sound great, but if it's compared to 10%, that is significant outperformance. And if we look back to the RBC example that we saw a few sessions back with the Canadian Equity Fund, I believe over 10 years, the TSX Composite was going about 5.95%. The RBC Canadian Equity Fund was averaging 3.6%. So your delta there was just over 2%. And if we recall the management expense ratios on those funds, if you were a low level investor for the Series A, you were paying 1.89% per annum in fees. And if you were a do-it-yourself investor, 1.05%. So when you're only averaging, or even the benchmark is only averaging under 6% per annum over 10 years, and you've got to recover 1 to 2% just to break even after fees, that's a substantial requirement to outperform. So when you look at it, you got to look at these fees and say, okay, does this make sense that I will actually outperform given the level of a benchmark return? And obviously the active investors do believe that. And that's kind of the debate. Okay, that's a look at passive investing and active investing. Complete opposites of each other. Now, intuitively, you look at that and you say, active investing is the way to go. Market timing, so we can avoid recessions by loading up on defensive or value stocks. Take advantage of market trends. Should be easy out of 500 S&P 500 companies to find the 300 or 400 best, load up on them and get rid of the 100 dogs. So active investing intuitively makes a ton of sense. And for many investors, it's obviously the way to invest. But since we're here listening to a podcast on passive versus active debate, it probably isn't that clear cut. Next session, we'll look at the case for active management, and there is indeed a strong case for active management. But we'll also look at the case for passive investing. So that'll be the upcoming couple of episodes. Thank you for listening today. Have yourself a good one.